Welcome to a new episode of OwlCast. I'm Juan Amazol, and today we're going to dive into a fascinating book that has the potential to transform our perspective on investments and financial success, The Little Book That Beats the Market by Joel Greenblatt. This book, originally published in 2005, has gained worldwide recognition for its simple yet powerful approach to investing in the stock market. Greenblatt, a hedge fund manager and professor at Columbia Business School, presents us with a strategy he calls the magic formula, designed to help investors of all levels consistently outperform the market. Over the next 20 minutes, we'll explore the 10 key points of this book and how we can apply them in our daily lives to improve our financial and investment decisions. Get ready for a fascinating journey through the world of smart investing. The heart of Greenblatt's book is his magic formula. This seemingly simple strategy is based on two fundamental criteria: return on capital and earnings yield. But don't be fooled by its simplicity. Behind it lies a deep understanding of the fundamental principles of investing. Imagine we're evaluating different business opportunities. We wouldn't just consider current profits, but also how efficiently the business uses its capital to generate those profits, right? Well, that's exactly what the magic formula does. Return on capital tells us how efficiently a company uses the money it has invested in its business. It's like evaluating how well a chef uses the ingredients at their disposal. On the other hand, earnings yield gives us an idea of how cheap the stock is relative to its earnings. It's like finding a bargain at the supermarket. Greenblatt argues that by combining these two factors, we can identify companies that are not only profitable but also undervalued by the market. It's like finding an excellent restaurant that, for some reason, isn't crowded with customers. But the beauty of the magic formula goes beyond its application in the stock market. It teaches us to evaluate opportunities holistically, considering both current performance and future potential. This approach can be applied in many areas of our lives, from choosing a career to deciding to start a business. The next time you face an important decision, ask yourself, am I considering both current performance and future potential? Am I looking for opportunities that offer a good return relative to what I'm investing, whether it's time, effort, or money? The magic formula reminds us that the best opportunities are often found in the balance between current value and future potential. And that, friends, is a lesson that can be applied far beyond the world of investments. One of the fundamental principles that Greenblatt emphasizes throughout the book is the importance of adopting a long-term perspective on investments. This concept is crucial not only for success in the stock market but also for achieving our goals in life in general. Greenblatt argues that most people don't succeed in their investments because they don't have the patience necessary to wait for their strategies to bear fruit. It's like planting a tree and expecting it to bear fruit the next day. Nature simply doesn't work that way, and neither does the stock market. Let's think about how we approach our personal and professional goals. When we start a new job or start a business, we don't expect to become experts or have great success overnight, do we? We know that success requires time, patience, and persistence. Greenblatt encourages us to apply the same mindset to our investments. He tells us that we should be prepared to hold our investments for at least 3 to 5 years, even if they experience short-term fluctuations. It's like a farmer who doesn't abandon his crops just because there's a temporary drought. This long-term mindset protects us from one of the investor's greatest enemies, emotionality. When we adopt a long-term perspective, we are less likely to panic and sell when the market temporarily drops, or to buy impulsively when it rises. Instead, we stay focused on the long-term fundamentals of our investments. But the lesson of long-term investment goes beyond the stock market. It teaches us the importance of patience and perseverance in all aspects of our lives. Whether building a career, a relationship, or a business, success rarely comes overnight. The next time you feel frustrated by the lack of immediate progress in some aspect of your life, remember Greenblatt's lesson about long-term investment. Ask yourself, am I giving enough time for my efforts to bear fruit? Am I maintaining the long-term perspective, or am I letting myself be carried away by short-term fluctuations? By adopting this long-term investment mindset, we not only become better investors but also more patient, persevering, and resilient people. And those, friends, are qualities that will serve us well in all aspects of our lives. Greenblatt challenges conventional wisdom about diversification in his book. While many financial experts recommend broad diversification, Greenblatt suggests that a portfolio of 20 to 30 carefully selected stocks can provide sufficient diversification. This smart diversification approach is one of the most intriguing and potentially controversial ideas in the book. Imagine you're preparing dinner for a group of friends. Conventional wisdom might suggest preparing a wide variety of dishes to ensure everyone finds something they like. But an experienced chef knows that with a careful selection of 5 or 6 well-prepared dishes, they can create a memorable culinary experience and satisfy all guests. Similarly, Greenblatt argues that we don't need hundreds of different stocks to have a well-diversified portfolio. Instead, he suggests focusing on a smaller number of high-quality companies that meet the criteria of his magic formula. This approach has several advantages. First, it allows us to really focus on understanding the companies we're investing in, rather than spreading our attention across too many options. Second, it reduces transaction costs and makes our portfolio easier to manage. And third, if we've selected our investments well, it gives us a better chance of outperforming the market. But the lesson of smart diversification goes beyond investments. It teaches us to be more strategic and focused in all aspects of our lives. Instead of trying to do everything and be good at everything, maybe we should focus on developing a smaller set of key skills that really set us apart. Think about your careers. Instead of trying to master every new trend or technology, wouldn't it be more effective to focus on deeply developing a few critical skills that really give you a competitive advantage? Or consider your personal relationships. Instead of trying to maintain a huge network of superficial acquaintances, wouldn't it be more rewarding to cultivate a smaller group of deep and meaningful friendships? Smart diversification teaches us to be more intentional and strategic in our choices. It reminds us that sometimes, less is more. The next time you face a decision about how to allocate your time, energy, or resources, ask yourself, am I diversifying intelligently? Am I focusing on the areas that really matter, or am I spreading my efforts too thin? By applying the principle of smart diversification in our lives, we can achieve greater impact and satisfaction, whether in our investments, careers, or personal relationships. One of the most powerful concepts that Greenblatt borrows from his mentor, Benjamin Graham, is the idea of the margin of safety. In the context of investments, this means buying stocks at a price significantly lower than their intrinsic value. It's like buying a house valued at $500,000 for only $300,000. That $200,000 discount is your margin of safety. But why is this concept so important? Well, the margin of safety protects us from two great enemies of the investor, error and uncertainty. First, let's acknowledge that we all make mistakes. We might misinterpret a company's financial statements, underestimate a competitor, or simply have bad luck. The margin of safety gives us a cushion against these errors. If we buy a stock at a substantial discount, even if our estimates are a little off, we can still get a good return. Second, the future is inherently uncertain. No matter how careful we are in our analysis, there will always be factors we can't predict. A global pandemic, a disruptive technological change, a new regulation, the margin of safety helps us protect ourselves against these unforeseen events. But the beauty of the margin of safety concept is that it can be applied far beyond the world of investments. Let's think about how we could apply it in our daily lives. In our professional career, having a margin of safety could mean developing a diverse set of skills that make us valuable in different roles or industries. It's like having a plan B built into our plan A. In our personal finances, it could translate into having an emergency fund that covers several months of expenses. This financial cushion gives us peace of mind and flexibility to make decisions without being under extreme pressure. In our personal relationships, the margin of safety could manifest as the patience and understanding we offer to our loved ones. By giving others the benefit of the doubt and a little extra margin, we build stronger and more resilient relationships. Even in our daily planning, we can apply this concept. If we have an important meeting, we don't plan to arrive exactly on time, do we? We leave early to have a margin of safety in case of traffic or unforeseen events. The margin of safety reminds us that we live in an uncertain world and that we all make mistakes. It encourages us to be humble, to plan for the unexpected, and to build resilience in all aspects of our lives. The next time you make an important decision, whether in your investments, your career, or your personal life, ask yourself, am I leaving a margin of safety? Have I considered what would happen if things don't go exactly as I planned? By incorporating the concept of margin of safety into our decision-making, we not only become better investors, but also more prepared and resilient people in the face of life's challenges and uncertainties. One of the most powerful and recurring messages in Greenblatt's book is the crucial importance of discipline. He emphasizes that following his investment strategy requires unwavering discipline, especially during periods of low performance. This lesson transcends the world of investments and applies to virtually all aspects of our lives. In the context of investments, discipline means sticking to our strategy even when the market seems to be against us. Greenblatt points out that even the best investment strategies can have periods of low performance. During these times, it's tempting to abandon the plan and look for something that seems to be working better at that moment. But Greenblatt argues that it's precisely in these moments that we must maintain discipline and stick to our plan. Imagine a marathon runner. During the race, there will be times when they feel tired, sore, and maybe even tempted to give up. But it's the discipline of continuing to run, of keeping the pace even when it's difficult, that allows them to reach the finish line. Similarly, in our investments, it's the discipline of following our strategy, even when the market is against us, that allows us to achieve our long-term financial goals. But the lesson of discipline extends far beyond investments. Let's think about how it applies to other aspects of our lives. In our professional career, discipline could manifest as the constant dedication to improving our skills, even when we don't see immediate results. It's the commitment to continue learning and growing, even when we feel stagnant or demotivated. In our health and well-being, discipline is what makes us maintain a healthy diet and exercise regimen, even when we don't see immediate changes on the scale. It's what makes us choose a salad instead of a hamburger, or wake up early to exercise, even when we'd rather stay in bed. In our personal relationships, discipline manifests as the constant commitment to work on the relationship, even during difficult times. It's the decision to communicate openly, to show love and appreciation even when we don't feel particularly loving or appreciative. In our personal projects or ventures, discipline is what makes us keep working day after day, even when we don't see immediate results. It's what drives us to get up every morning and take one more step towards our goals, even when the path seems long and difficult. Discipline is, in many ways, the bridge between our goals and our achievements. It's what turns our aspirations into reality. Without it, even the best strategies and the most brilliant plans can fail. Greenblatt reminds us that discipline is not always easy. There will be moments when we doubt ourselves, when we feel tempted to abandon our plan. But it's precisely in these moments that discipline is most important. The next time you face a challenge, whether in your investments, your career, your health, or your relationships, ask yourself, am I maintaining discipline? Am I following my plan, even when it's difficult? Remember, discipline is not just doing what's easy when we feel motivated. True discipline is doing what is necessary, especially when it's difficult and when we least want to do it. By cultivating discipline in all aspects of our lives, we not only become better investors but stronger, more resilient people, more capable of achieving our goals, no matter what obstacles we encounter along the way. One of the most pernicious myths in the world of investments, and in life in general, is the idea that there is a perfect time to act. Greenblatt devotes considerable attention to dismantling this fallacy in his book, and his ideas have profound implications beyond the stock market. In the context of investments, the fallacy of perfect timing manifests as the attempt to time the market, that is, trying to predict exactly when the market will reach its lowest point to buy, or its highest point to sell. Greenblatt argues convincingly that this is a losing game for the vast majority of investors, even for professionals. Why? Because the future is inherently uncertain and unpredictable. Nobody has a crystal ball that can accurately predict market movements. Even the most respected experts often get their predictions wrong. Instead of trying to time the market, Greenblatt advocates for a more systematic and disciplined approach. He suggests regularly investing in good companies at reasonable prices, regardless of what the market in general is doing. It's like planting seeds regularly in a garden, instead of trying to predict the perfect day for planting. But the lesson of the fallacy of perfect timing extends far beyond investments. Let's think about how this idea manifests in other aspects of our lives. In our professional career, we might fall into the trap of waiting for the perfect moment to ask for a promotion, change jobs, or start our own business. But the reality is that there is rarely such a thing as the perfect moment. While we wait for ideal conditions, we could be missing valuable opportunities. In our personal relationships, we might postpone having that difficult but necessary conversation, waiting for the right time. But often, the best time is simply now, before problems accumulate and become more difficult to address. In our personal goals, such as losing weight, quitting smoking, or learning a new skill, we might fall into the trap of thinking I'll start on Monday, or when things calm down at work. But as we all know, that perfect Monday rarely comes. The key lesson here is that, instead of waiting for the perfect moment, we should focus on taking consistent and regular action. It's better to take small imperfect steps towards our goals than to wait eternally for the perfect moment to take a big leap. This doesn't mean we should act impulsively or without planning. But it does mean we should be aware of the paralysis that can result from the pursuit of perfection. The next time you find yourself postponing an important decision or action, ask yourself, am I waiting for the perfect moment? Am I letting the search for ideal conditions prevent me from moving forward? Remember, as the famous writer Mark Twain said, the secret of getting ahead is getting started. Don't wait for the perfect moment. The best time to act is now. Although Greenblatt's book presents a seemingly simple strategy for investing in the stock market, the author does not underestimate the importance of continuous financial education. In fact, this is an underlying theme throughout the book and deserves our special attention. Greenblatt argues that to succeed as an investor, it's not enough to blindly follow a formula or strategy. It's crucial to understand the fundamental principles behind that strategy, and to be constantly learning and adapting as the market and our understanding evolve. This applies not only to investments, but to all aspects of our personal finances. Financial education empowers us to make informed decisions, to question the advice we receive, and to adapt our strategies as our personal circumstances and the economic environment change. Let's think about how financial education can impact different aspects of our lives. In our personal budget, financial education helps us understand the difference between needs and wants, prioritize our spending, and find creative ways to save without sacrificing our quality of life. In debt management, it allows us to understand the different types of debt, interest rates, and strategies to pay off our debts efficiently. In retirement planning, it helps us understand the different investment vehicles available, how compound interest works, and how to balance risk and reward as we approach retirement. In protecting our assets, it allows us to understand the importance of insurance and how to choose the right policies for our needs. But financial education goes beyond numbers and strategies. It also involves developing a healthy mindset towards money. It helps us understand that money is a tool, not an end in itself. It allows us to see beyond short-term gratifications and think about our long-term financial goals. Moreover, financial education gives us the power to take control of our finances, rather than feeling at the mercy of circumstances or experts. It allows us to ask informed questions, critically evaluate the advice we receive, and make decisions that align with our personal values and goals. Greenblatt reminds us that financial education is an ongoing journey, not a destination. The financial world is constantly evolving, and there's always something new to learn. Whether it's reading books, attending seminars, following financial blogs, or simply discussing financial topics with friends and family, there are many ways to continue educating ourselves. The next time you face an important financial decision, ask yourself, do I have all the information I need to make this decision? Is there anything else I need to learn? Remember, knowledge is power, especially when it comes to our finances. By committing to continuous financial education, we not only become better investors, but we also empower ourselves to take control of our financial future and achieve our life goals. One of the most important distinctions Greenblatt makes in his book is between investing and speculating. Although both activities involve placing money with the hope of obtaining a return, the mentality and approach behind each are fundamentally different. An investor, according to Greenblatt, seeks to buy a part of a business at a reasonable price with the expectation of obtaining a long-term return based on the fundamental performance of that business. A speculator, on the other hand, tries to predict short-term movements in a stock's price, often based on factors that have little to do with the intrinsic value of the underlying business. This distinction is crucial because it profoundly affects how we approach our financial decisions. The investor's mentality leads us to think long-term, to focus on the fundamentals of the business, and to maintain calm in the face of short-term market fluctuations. The speculator's mentality, on the other hand, can lead us to make impulsive decisions based on rumors, emotions, or attempts to time the market. But this lesson goes beyond the world of finance. The distinction between the investor's mentality and the speculator's can be applied to many areas of our lives. In our professional career, an investor mentality would lead us to focus on developing valuable skills and building solid long-term relationships, instead of seeking quick gains or jumping from one job to another without a coherent plan. In our personal relationships, an investor mentality would encourage us to invest time and effort in nurturing deep and meaningful connections, instead of seeking immediate gratification or superficial relationships. In our health and well-being, an investor mentality would lead us to adopt sustainable long-term healthy habits, instead of falling into the trap of fad diets or extreme workouts that promise quick but unsustainable results. In our personal development, an investor mentality would encourage us to commit to continuous learning and gradual growth, instead of seeking quick fixes or shortcuts. The investor's mentality teaches us to value patience, consistency, and long-term focus. It reminds us that true value is often built slowly over time, and that the most significant rewards often require sustained commitment. Of course, this doesn't mean we should never take risks or seize short-term opportunities. Even Greenblatt recognizes that there may be a place for speculation in a well-diversified portfolio. The key is to be aware of when we are investing and when we are speculating, and to ensure that our actions align with our long-term goals and risk tolerance. The next time you face an important decision, whether financial or otherwise, ask yourself, am I approaching this with an investor's mentality or a speculator's? Am I thinking long-term or seeking a quick gain? Remember, as legendary investor Warren Buffett said, the stock market is a device for transferring money from the impatient to the patient. By cultivating the investor's mentality in all aspects of our lives, we not only become better managers of our money, but also more patient, focused people capable of building lasting value in everything we do. One of the most challenging but potentially rewarding concepts that Greenblatt presents in his book is the idea of going against the current. In the context of investments, this often means buying stocks that are unpopular or ignored by most investors, but which have solid financial fundamentals. Greenblatt argues that to outperform the market, we often need to do the opposite of what the majority does. This is because when everyone is enthusiastic about a particular stock or sector, prices tend to inflate beyond their real value. On the other hand, when a stock or sector is unpopular, it is often undervalued, creating opportunities for patient and disciplined investors. However, going against the current is not easy. It requires courage, confidence in our analysis, and the ability to resist social and emotional pressure to follow the crowd. It's much more comfortable to do what everyone else is doing, even if logic tells us it might not be the best decision. This lesson of going against the current has powerful applications beyond the world of investments. In our professional career, going against the current could mean choosing an unconventional path that better aligns with our passions and skills, even if it's not what's expected of us or what our peers are doing. In entrepreneurship, it could mean identifying and addressing a market need that others have overlooked, instead of following the latest fashion trends. In our personal development, it could mean adopting habits or practices that go against social norms, but that we know are beneficial for us in the long run. In our life decisions, it could mean choosing a lifestyle that aligns with our values, even if it goes against conventional social expectations. Going against the current teaches us to think independently, to trust our own analysis, and to have the courage of our convictions. It reminds us that the path to success and fulfillment is often not the most traveled. However, it's important to note that going against the current doesn't mean being contrary just for the sake of it. Greenblatt emphasizes the importance of basing our decisions on solid analysis and fundamental principles, not on emotion or the desire to be different. The next time you face an important decision, ask yourself, am I following the crowd simply because it's easier or more comfortable? Have I done my own analysis and reached my own conclusions? Remember, as famous investor Sir John Templeton said, if you want to have better results than the crowd, you must do things differently from the crowd. By cultivating the ability to go against the current when necessary, we not only become better investors, but also more independent thinkers and more effective leaders in all aspects of our lives. The last key point I want to highlight from Greenblatt's book is his emphasis on simplicity. In a financial world that often seems to value complexity and sophistication, Greenblatt advocates for a surprisingly simple approach to investing. His magic formula is based on just two criteria: return on capital and earnings yield. It doesn't require complex calculations or the use of insider information. It's a strategy that anyone can understand and apply. Greenblatt argues that this simplicity is actually a strength. A simple approach is easier to understand, easier to follow, and less prone to errors. Additionally, simplicity helps us maintain discipline in difficult times, because we clearly understand what we're doing and why. But the lesson of simplicity extends far beyond investments. In a world that often glorifies complexity, simplicity can be revolutionary. In our professional life, simplicity could manifest as the ability to communicate complex ideas clearly and concisely, or to simplify complicated processes to make them more efficient. In our personal life, it could mean clearing physical and mental clutter, focusing on what really matters and eliminating the superfluous. In our goals and aspirations, simplicity encourages us to clearly define what we want and create straightforward plans to achieve it, rather than getting lost in a tangle of confusing goals and complicated strategies. In our relationships, simplicity could manifest as honesty and direct communication, instead of complicated emotional games. Simplicity frees us. It allows us to focus on the essential, reduce stress and information overload, and increase our effectiveness and satisfaction in life. However, it's important to note that simple doesn't mean simplistic. Greenblatt's strategy is simple, but it's based on sound financial principles and years of research. Similarly, seeking simplicity in our life doesn't mean ignoring the complexity of the world, but finding clear and direct ways to navigate that complexity. The next time you face a complex problem or decision, ask yourself, is there a simpler way to approach this? Am I unnecessarily complicating things? Remember, as the famous designer Leonardo da Vinci said, simplicity is the ultimate sophistication. By cultivating simplicity in our investments and in our life, we not only free ourselves from unnecessary stress and confusion, but we also open ourselves to a clearer, more focused, and potentially more successful way of living. In conclusion, The Little Book That Beats the Market by Joel Greenblatt offers us much more than an investment strategy. It provides us with a set of principles that we can apply to improve not only our finances, but also our way of thinking and living. From the importance of discipline and continuous education, to the value of going against the current and embracing simplicity, these lessons equip us to better navigate not only the stock market, but also the complex challenges of modern life. Let's remember that success, whether in investment or in life, is not about finding magical shortcuts or secret formulas. It's about applying sound principles consistently and with discipline over time. It's about thinking long-term, being willing to go against the current when necessary, and keeping things simple and focused. As we always emphasize on OwlCast, this summary is just an introduction to the valuable ideas contained in The Little Book That Beats the Market. We strongly encourage you to read the entire book to delve deeper into these concepts and discover how you can apply them in your own financial life. Remember, financial knowledge is power. It gives us the tools to take control of our financial future, to make our money work for us, and to build the security and freedom we all long for. So, let's keep learning, let's keep growing, and let's keep applying these principles in our pursuit of a wiser and more satisfying financial life. And above all, let's remember that the true value of any strategy or principle is revealed in its constant and disciplined application over time. Thank you for joining us on this journey through The Little Book That Beats the Market. We hope these ideas inspire and empower you in your own financial journey. Until the next episode, keep investing wisely and living with purpose. Until next time.